Something changed inside LIV Golf the moment a mysterious $30 million contract audit demand surfaced around Phil Mickelson's HyFlyers franchise. In this developing scenario, the notification was directed to HyFlyers management and requested a review of a financial arrangement tied to the franchise's early funding structure and Phil Mickelson's captaincy allowances. The demand did not initially accuse Mickelson of misconduct. Instead, it questioned how the $30 million allocation had been documented, approved, and classified. The amount was reportedly tied to seed funding, establishment costs, and discretionary resources made available during formation. Mickelson's position was that the spending fell within a budget already authorized for building and operating the franchise. But the parties disagreed over what discretionary actually meant. For HyFlyers financial backers, authorization to spend money did not necessarily mean unlimited authority to move funds between categories without additional documentation. Their concern was whether the original agreement clearly separated franchise expenses from captain-related benefits, commercial activities, and other expenditures associated with Mickelson's role. But before we go any further, I want to hear from you. How old are you, and how long have you been following Phil Mickelson or LIV Golf? How old are you? Drop your age in the comments below. And if you're enjoying this breakdown, make sure to subscribe so you don't miss the next major development. That is where this story takes its first significant turn. What began as a request to examine one $30 million contract quickly became a question about the unusual financial structure behind LIV Golf franchises. A player captain can function as an athlete, public representative, and stakeholder in the team's operation. That creates complicated boundaries around who approves spending and who answers for it. For Mickelson, the defense was straightforward. The money had been approved for franchise establishment and should be judged within that framework. For the investors seeking the audit, the issue was equally straightforward. Approval was not the same thing as transparency. And with the $30 million figure now at the center of the dispute, both sides faced a bigger question. What exactly did the original HyFlyers agreement authorize? The $30 million demand might have remained a narrow contractual dispute if the accounting review had stopped at the original agreement. Instead, the examination began moving in a different direction. Once the auditors started comparing the contract language with the underlying financial records, the question was no longer simply how much money had been approved. It became a question of how that money had actually been classified and spent. That distinction matters. In this developing scenario, forensic accountants began reviewing HyFlyers' operating ledgers against invoices, reimbursement records, vendor agreements, travel expenses, and branding expenditures. Several categories that had previously been grouped under broad franchise development expenses were separated for closer examination. Operational overhead became one area of attention. Expenses connected to team travel, hospitality, logistics, and administrative support were being reviewed to determine whether they belonged entirely to the franchise or had been charged against discretionary captaincy allocations. Branding created another complication. Mickelson was not simply the team's captain. His name was part of the commercial identity of HyFlyers. That created a difficult accounting question. When an expense promoted both the franchise and Mickelson's personal brand, which entity was supposed to absorb the cost? The same question applied to appearances, promotional events, media commitments, and certain travel arrangements. None of those categories by themselves established wrongdoing, but they exposed a structural problem that had been easier to overlook while the franchise was being built. The boundaries between the captain, the team, and the broader LIV business operation were not always as clean as traditional sports accounting models would suggest. That became particularly important because of the dual role at the center of the franchise structure. A player captain could have influence over team decisions while simultaneously benefiting from the team's commercial success. In practical terms, that meant an expense could be legitimate for the franchise while still requiring additional disclosure because of who authorized it. The audit board therefore widened its questions. Instead of examining only the disputed $30 million agreement, reviewers began requesting supporting documentation for contracts signed under the HyFlyers banner. Since the franchise's inception, vendor agreements, Sponsorship arrangements, player-related payments, marketing commitments, and internal approvals all moved into the review. The financial dispute was changing shape. What began as a disagreement over one discretionary budget was becoming an examination of the accounting system itself. And once auditors began asking where the money went, the next question became unavoidable. Who had the authority to decide where it went in the first place? The audit took its next major turn when investigators moved from operating expenses to the money used to build the HyFlyers roster. That shift changed the stakes immediately. A question about accounting categories was now touching the contracts of the players who had been recruited to represent the franchise. In this developing scenario, auditors began examining how recruitment incentives had been structured for established LIV players, prospective signings, and younger talent being considered for future roster positions. The focus was not simply on headline salaries. Reviewers wanted to understand the additional commitments attached to those agreements: signing bonuses, performance guarantees, appearance obligations, commercial incentives, and other payments that could influence the true cost of assembling the team. That distinction matters because a player contract can look straightforward on paper while carrying substantial financial commitments outside the headline figure. The review reportedly raised questions about whether certain recruitment payments had been funded directly through HyFlyers franchise, covered through broader league allocations, or treated as part of Mickelson's discretionary captaincy budget. The accounting treatment became particularly sensitive around guarantees. If a captain had authority to use franchise capital to secure a player, investors would want to know exactly where that authority ended. Could a captain commit future team funds to attract a marquee player? Could a recruitment incentive be approved before the franchise had formally budgeted for it? And if a player was promised compensation through multiple agreements, which entity was ultimately responsible for honoring those commitments? Those questions also brought younger players into the discussion. The audit team began reviewing proposed development arrangements and, in this fictional reporting scenario, potential name, image, and likeness incentives connected to emerging talent. The issue was not whether those incentives were automatically improper. The concern was whether every commitment had been properly disclosed, approved, and assigned to the correct financial entity. That distinction could become critical if competing interpretations emerged between the franchise and its investors. A payment recorded as a team expense could look very different if another party considered it a captain-authorized recruitment expense. Likewise, a league-supported incentive could change the financial picture if HyFlyers had initially treated it as money coming from its own reserves. By this point, the $30 million audit was no longer confined to a single agreement. The review was beginning to map the financial commitments behind the entire roster, and that created the most uncomfortable possibility yet. If previously signed player arrangements had been approved under different interpretations of the franchise's financial authority, the dispute might not end with Mickelson. It could force HyFlyers to review whether every major recruitment commitment had been properly documented and whether the captain-owner model had created contractual ambiguity from the beginning. What do you think? Could a situation like this force HyFlyers to rethink the way its player-captain model operates? Let me know your thoughts in the comments below. And if you're following this developing story, make sure to subscribe so you don't miss what happens next. The audit became significantly more serious when the questions moved beyond HyFlyers' internal accounts and reached the companies attached to the franchise. Until this point, the dispute could still be characterized as a disagreement between franchise backers and the team's leadership. But once commercial partners began asking how their money was being allocated, the pressure entered an entirely different arena. In this developing scenario, apparel companies, equipment partners, and other corporate sponsors began seeking greater clarity around the financial structure supporting HyFlyers. Their concern was not necessarily the $30 million figure itself. It was whether sponsorship money, franchise capital, and captain-controlled resources were being kept sufficiently separate. That distinction became important because sponsorship agreements often contain specific commercial obligations. A company may pay for branding rights, promotional appearances, hospitality opportunities, or digital campaigns. If those commitments are handled through multiple entities, determining exactly where the revenue belongs can become complicated. Auditors therefore began examining the relationship between team sponsorship accounts, franchise equity, and entities connected to the captain. The central question was simple: when a sponsor paid HyFlyers, who controlled the resulting revenue, and how much of that money could be redirected toward broader franchise expenses. The review also placed pressure on future sponsorship payments. Corporate backers, concerned about the growing uncertainty, could demand independent verification before additional funds were released. That would represent a meaningful change. Sponsors would no longer be treating the franchise purely as a marketing platform. They would be looking at its financial governance as part of the commercial relationship. For HyFlyers, that creates a difficult balancing act. The franchise needs sponsors to maintain its commercial strength, but increased oversight can reduce the flexibility that helped player-led teams operate differently from traditional sports organizations. Every additional approval requirement could slow recruitment, branding decisions, travel arrangements, and other day-to-day operations. And that is where Mickelson's position becomes more complicated. His name remains central to the franchise's identity, but the audit is increasingly examining structures that extend beyond any one individual. If sponsors require independent oversight, then the question is no longer whether Mickelson personally had authority over a particular expense. It becomes whether HyFlyers had a governance system capable of separating captain influence from corporate financial control. By this stage, the original $30 million demand had effectively changed character. What began as a contract review was becoming a commercial governance examination involving investors, accountants, sponsors, and franchise leadership. And once outside partners started asking for the ledger, another concern became difficult to ignore. If HyFlyers needed this level of scrutiny, were other LIV franchises operating under the same financial ambiguity? That final question is where the HyFlyers dispute could become much larger than Phil Mickelson. Once word of the audit began circulating through the LIV Golf ecosystem, executives at other franchises had a reason to look closely at their own financial arrangements. The concern was not necessarily that every team had the same problem. It was that the same structural questions could exist elsewhere. Who controls franchise money? Which expenses require approval? And where does a player captain's authority stop? In this developing scenario, private equity groups connected to other LIV franchises quietly began commissioning independent financial reviews. Their objective was not to launch accusations against individual captains. It was to determine whether their own contracts, sponsorship accounts, recruitment budgets, and operational expenses were being recorded under consistent standards. Several pressure points quickly emerged. Player recruitment was one. If one franchise had flexibility to offer signing incentives through captain-controlled resources, investors elsewhere would want to know whether similar commitments existed on their books. Commercial rights were another. Sponsors may have negotiated directly with teams, league entities, or commercial companies associated with individual franchises. That created potential questions about how revenue was distributed and whether every party understood which entity actually controlled the money. Then there was operational ambiguity. Travel, hospitality, marketing, player appearances, equipment, staff costs, and promotional campaigns can all serve more than one purpose. A team may legitimately spend money in each category, but the accounting becomes more complicated when the captain also has a personal commercial interest in the franchise. That is why the HyFlyers audit could have a contagious effect. The moment one ownership group begins asking for documentation, others have an incentive to conduct their own reviews before a problem reaches them. In corporate governance, that is often how isolated questions become industry-wide scrutiny. For LIV Golf, the timing would be particularly sensitive. The league's franchise model was built around teams with distinctive identities and influential player captains. That structure helped differentiate LIV from the traditional PGA Tour model, but the same flexibility that allowed franchises to operate with individual personalities also created questions about standardized financial oversight. Now, those questions were moving from the accounting department into the league's boardroom. If multiple franchises discovered different interpretations of recruitment spending, commercial revenue, or captain authority, LIV could face pressure to establish a common financial framework across the entire ecosystem, and that would transform the story. The original headline was about HyFlyers and a disputed $30 million contract. The larger issue was whether the league had created a franchise system where ownership, athletic leadership, and financial control could overlap without clear boundaries. For Mickelson, that means the audit could become more than a dispute over his own financial arrangements. It could become the case that forces LIV Golf to explain how its entire franchise model is supposed to work. The immediate question now is what happens to the original $30 million audit. In this developing scenario, the review has moved beyond a single contract and toward a broader examination of HyFlyers' financial governance, with mediation potentially becoming the next step between franchise leadership, investors, and Mickelson's representatives. If player captains are allowed to operate with significant control over franchise resources, future agreements may need clearer limits on discretionary spending, recruitment commitments, sponsorship revenue, and personal commercial expenses. Investors will want defined approval procedures, sponsors will want stronger financial safeguards, and league officials could face pressure to establish uniform standards across every franchise. That would represent a meaningful evolution for LIV Golf. The player-owner model was designed to give teams distinctive identities and greater independence, but independence becomes harder to maintain when substantial capital is involved and multiple parties have competing interests. The HyFlyers dispute, therefore, could become a test of whether that model can survive increased corporate transparency. If the audit ultimately confirms that the $30 million was properly authorized and accounted for, the immediate controversy may fade, but if it exposes unclear agreements or inconsistent financial controls, the consequences could extend well beyond Mickelson. For professional golf, the lesson would be straightforward. Ownership can create influence, but influence without clearly defined financial boundaries can eventually become a governance problem. And that leaves the central question hanging over LIV Golf, not simply where the $30 million went, but whether the captain-owner model was built with enough transparency to survive the level of scrutiny that modern professional sports now demands. But what do you think? If you were in charge of a LIV franchise, would you trust the captain-owner model as it stands, or would you demand stricter financial oversight? Drop your answer in the comments below. And if you want to stay updated as this story develops, make sure to subscribe.